All right, everyone, get ready, because this week we are diving headfirst into the minutes from September's Fed meeting.
You know the one, right?
The one where they decide if interest rates live or die. And let me tell you, deciphering these minutes, it's like trying to read tea leaves at the bottom of a murky cup.
Yeah, it can be tough to see through the jargon sometimes.
Exactly. But that's why we're here to make sense of it all.
Especially since these meetings have real-world consequences. For you, for me, for your neighbor.
So let's unpack what the Fed was really thinking, shall we? Let's rewind to early August for just a sec. Remember those market jitters we saw?
Oh, yeah?
Turns out the Fed was paying attention. They even called out a few specific events that helped trigger it all.
They did. They specifically mentioned that Bank of Japan announcement, remember, totally out of the blue, hinting they might actually raise interest rates.
Right. Everyone thought they'd stay the course.
Tell me about it. Really threw a wrench into things, especially for investors who'd bet big on Japan keeping things as they were.
And to make matters worse, didn't we also get a not-so-great jobs report here in the U.S. right around the same time?
We did. Weaker than expected, for sure. That definitely added fuel to the fire. You put those two events together, and it's no wonder investors got spooked.
Right. Talk about a 1-2 punch.
Exactly. The Fed's minutes actually used the phrase speculative trading, suggesting some investors were making some risky bets that didn't quite pan out.
So this wasn't just a random blip. It revealed a potential vulnerability in the market.
It did. And the Fed's taking notes, believe me. This kind of volatility makes them nervous because, left unchecked, it can spill over into the real economy. And nobody wants that.
Confidence is key. When the markets get shaky, people get nervous. Which brings us to the main event. Interest rates.
The Fed's favorite topic.
Always. The big news, of course, is that they finally hit the brakes and cut rates. But something tells me it wasn't exactly a unanimous decision.
What gave it away?
Call it a hunch. So give me the inside scoop, what went down.
Okay, so the headline is that they lowered rates by 0.5 percentage point. The target range now sits between 4.75% and 5%. But, and this is where it gets juicy, not everyone was doing a happy dance about it.
I knew there had to be some drama.
The minutes use this phrase, substantial majority. That's how they describe the support for the half-point cut.
Substantial majority, meaning?
Meaning some people weren't thrilled. Some members wanted a smaller cut, maybe just 1/4 point. They thought it was the more cautious approach, given everything else going on in the economy.
I see, playing it safe.
Exactly. And then there's Michelle Bowman.
Michelle Bowman, our favorite dissenter. What did she have to say?
Oh, you know Michelle? Never one to shy away from a hot take. She voted against a rate cut entirely.
Wow, really?
Yep. She argued that with core inflation still high, the labor market still going strong, and decent economic growth overall, there was no need to cut rates just yet.
Interesting. So it seems like the Fed is walking this tightrope trying to manage inflation without sending the economy into a tailspin.
A balancing act, for sure.
And on top of all that, we can't forget about their other big move, shrinking the balance sheet.
Right. It's like this whole other lever they can pull to influence the economy. Remember how they bought trillions of dollars of bonds and mortgage-backed securities a few years ago?
Yeah, to try to prop things up.
Exactly. Pumping money into the system. Well, now they're slowly but surely reversing course, selling off those assets.
So if buying those assets was like hitting the gas, selling them off is easing off the accelerator.
Perfect analogy.
Yeah.
And this move has the opposite effect of cutting interest rates. It gradually pulls money out of the system, helps to cool things down a bit.
So they're cutting rates on one hand and then tapping the brakes with the other.
You got it.
So they're cutting rates, but at the same time, tapping the brakes by shrinking their balance sheet. Sounds a little tricky, don't you think?
It is. It's a delicate balance, for sure.
So how's the economy actually holding up amidst all of this maneuvering?
It's the million-dollar question, right? But there is some good news. The U.S. economy, it's proving to be remarkably resilient. Even the Fed admits that despite all the doom and gloom headlines, we're not seeing a full-blown slowdown just yet.
Okay, that's a relief. I was getting a little nervous there for a second. But I'm guessing it's not all sunshine and rainbows. There are always those mixed signals to watch out for.
Right. Always something. Right. And the current jobs picture is the perfect example of that. You've got some indicators that on the surface seem kind of negative.
Oh no, like what?
Well, payroll growth is slowing down and unemployment ticked up to 4.2%. Not exactly something you want to see.
Definitely not. Not a great look. What's the Fed saying about all of this?
Well, they're digging a little deeper into the numbers, looking at the nuances. For example, the labor force participation rate. That actually went up. More people are coming back into the job market, which in a way is actually a good sign, shows confidence in the economy.
Right. More people wanting to work.
Exactly. But it also means that the unemployment rate might not be giving us the full picture.
It's not as simple as just looking at one number then.
Not at all. The job market is way too complex for that. The Fed is likely looking at other data too, like wage growth, overall hiring trends, all that, to get a more complete picture. And from what they're seeing, it seems like the job market is cooling, but not collapsing.
This is actually what they want if they're trying to control inflation.
Bingo.
Yeah.
A red-hot job market doesn't do anyone any favors when it comes to inflation. Too much demand for workers, wages start climbing, and then those costs get passed right along to consumers. A more moderate pace is what we're all hoping for.
Makes sense. Okay, so can we talk about the elephant in the room, inflation? Because that's what this all boils down to, right? Is it still keeping the Fed up at night?
It's definitely still on their radar, but I have to say, the tone in these minutes feels a bit more optimistic than before. Even cautiously optimistic, which is saying something.
Well, we'll take any good news we can get. We've all felt the pinch of higher prices over the past year.
Tell me about it. But for now, inflation seems to be cooling down, and the Fed seems more confident that it will eventually get back to that magical 2% target.
Okay, so they're feeling good about hitting their inflation target. That's what they're aiming for. But as we've established, they're not infallible, are they? What could throw a wrench into their plans? What are they worried about? So they're feeling good about hitting their inflation target. That's what they're aiming for. But as we've established, they're not infallible, are they? What could throw a wrench into their plans? What are they worried about?
That is the million-dollar question. And it really gets to the heart of why the Fed's job is so tricky right now.
Because
Because they're trying to walk this tightrope, you see. Slow down inflation without sending us into a recession.
easier said than done, right?
Way easier. Think of it like trying to land a plane on a super windy day.
Okay.
You need a steady hand, and you can't take your eyes off those gauges.
I like that analogy. Even with the best pilots, there's always that chance of hitting some turbulence. So what are some of the potential storm clouds the Fed is watching out for? What could rock the boat?
Well, there are always the geopolitical risks, right? We saw how those events in Japan rippled through the markets. Things can change overnight on the world stage, and there's not much anyone can do about it.
Sure. Unpredictable.
Completely unpredictable. And then you have to think about consumer behavior. What if, and this is a big what if everyone just goes on a spending spree, despite inflation?
Oh, that wouldn't be good.
Not good at all. That could really throw a wrench in things. The Fed wouldn't like that one bit.
So they've got to be ready to adapt, always adjusting.
Absolutely. They can't just set it and forget it. They're
Yeah.
constantly watching, monitoring, analyzing. In fact, the minutes emphasize just how much uncertainty there is right now.
Makes sense. Nobody has a crystal ball?
Exactly. They even admit they might have to change course depending on how the economy responds. And you can't really blame them, can you?
Nope. Which is why everyone hangs on their every word. So let's bring it all home. What does all this Fed talk actually mean for our listeners, for their wallets? Let's start with those interest rates we talked about, the ones the Fed just lowered.
Right, so
Seemed like a big deal.
it is a big deal.
Huh?
Lower interest rates generally mean cheaper borrowing costs. Think about it. Mortgages, car loans, loans for your business, it can make a real difference.
Right. Makes those monthly payments a little less painful.
Exactly. In theory, it can also give a little boost to the stock market.
So good for borrowers, good for investors. Sounds like a win-win. But I'm sensing a but coming. There's always a flip side, isn't there?
Well, there's always a trade-off. If the economy gets too hot, like really heats up because of these lower rates, then we could see inflation creeping back in. And then we're right back where we started, with higher prices eating away at everyone's hard-earned money.
A vicious cycle no one wants to see happen, so we've got to stay vigilant, keep an eye on things.
Eyes peeled.
Uh,
So between now and the next Fed meeting in November, what should we be watching for? I'm glad you asked. First and foremost, inflation. Check those reports religiously. Is it really cooling down, or are we just fooling ourselves?
Okay, inflation reports. Got it. Anything else?
Also, pay attention to businesses. What are they doing? Are they hiring, expanding, or are they pumping the brakes? That'll tell you which way the wind is blowing.
Inflation numbers, the business vibe. Got it.
You got this.
Any final words of wisdom as we try to navigate these uncertain economic waters?
No, just remember, the Fed doesn't have a crystal ball. They're just trying to make the best decisions they can with the information they have. The best thing you can do, stay informed, be prepared in case things change, and whatever you do, don't panic.
Sound advice. Well, thank you so much for diving into the Fed's world with me. And for you all listening out there, thanks for joining us for another deep dive. We'll see you next time.